Hello and welcome to India Trade Talk. In this series, we'll break down the essential components of fundamental analysis, starting with the understanding financial statements. Today, we'll focus on the income statement. The income statement, also known as the profit and loss statement, is a crucial part of company's financial health. It provides a summary of company's revenues, expenses, and profits over the specific period. Let's dive into its components through the story of a small pizza shop. Meet Raj, the owner of Raj Pizzeria, a small yet beloved pizza shop in the town. Raj Pizzeria is famous for its mouth-watering pizzas and the warm, friendly services that Raj and his team provide. Today, we'll walk through Raj's income statement to understand how his business performs financially. First, let's look at the revenue. Raj Pizzeria generates income primarily through pizza sales. This is called operational revenue. Last year, Raj Pizzeria made 9 lakh rupees from selling pizzas and drinks. Additionally, Raj earned 1 lakh rupee from other sources such as interest from bank deposits and selling an old oven. This is categorized as other income. So, total revenue becomes rupees 10 lakh for the last year. Next, we look at the cost of goods sold or COGS. These are the direct costs of producing the pizza. For Raj Pizzeria, this includes the cost of ingredients like flour, cheese, and toppings. Last year, Raj spent 4 lakh rupees on these ingredients. Next, we will look at the gross profit Raj made in the last year. Gross profit is the difference between total revenue and COGS. For Raj Pizzeria, the gross profit is 10 lakh minus 4 lakh, which equals rupees 6 lakh. Next is operating expenses, which include all the costs required to run the pizza shop that are not directly tied to producing the pizzas. This includes rent, utilities, wages, and market expenses. Raj Pizzeria spent nearly 3 lakh rupees on operating expenses last year. This leads us to operating income. Operating income is calculated by subtracting operating expenses from gross profit. For Raj Pizzeria, the operating income is rupees 6 lakh minus rupees 3 lakh, which equals rupees 3 lakh. Next, we need to take depreciation into consideration. Last year, Raj bought some equipments like ovens and refrigerators for his pizzeria. Depreciation is the reduction in the value of such assets over time. Raj calculates an annual depreciation of rupees 30,000 for his equipments. Finally, we take into consideration the interest which Raj pays on the business loan he has taken couple of years back. This year, Raj paid rupees 20,000 as interest on the business loan. After considering depreciation and interest on business loan, we can calculate Raj's profit before tax, often referred as PBT. This is the profit which Raj earned last year and will be paying taxes on this amount. Raj's profit before tax is rupees 3 lakh minus rupees 30,000 minus rupees 20,000, which calculates to rupees 2 lakh 50,000. Rupees 3 lakh is the operating income here. Raj paid a total tax of rupees 55,000, which is 22% on the profit before tax. Net income, also known as the bottom line, is the total profit after all expenses, including depreciation, interest, and taxes, have been deducted from the total revenue. For Raj Pizzeria, the net income is rupees 2,50,000 minus 55,000, which equals 1,95,000. Now, let's take a real world example. We look at the income statement of ITC Limited to see how these concepts apply to a large company. In the latest fiscal year, ITC reported operational revenue of about 76,840 crore rupee. Additionally, it earned about 2,727 crore rupee from other income sources, making the total revenue about 79,568 crore rupee. The cost of goods sold was about 21,772 crore rupee, leading to a gross profit of about 57,795 crore rupee. With operating expenses of about 28,813 crore rupee, the operating income was about 28,982 crore rupee. Here, sections B, C, D, E, and H constitutes the operating expenses. The company paid almost 46 crore rupee in interest on its loans, which is shown as financial cost in the annual report. The company accounted for about 1,816 crore rupee in depreciation. So after considering all these expenses, company's profit stood at 27,147 crore rupee. This also includes about 27.6 crore rupee which company earned from its joint ventures with some other companies. The company also paid about 6,388 crore rupee in taxes on its earnings, which includes current year's taxes and some deferred taxes from previous years. After accounting for taxes, interest, and depreciation, the net income stood at about 20,751 crore rupee. There are some other small components which are beyond scope of the current video, which we will cover in separately in future. These components are not common among all the companies and may or may not be present in other companies' income statement. Understanding the income statement is crucial for evaluating a company's profitability and operational efficiency. In the next video, we'll dive into the balance sheet to understand a company's financial position. If you found this video helpful, please like, share, and subscribe for more stock market insights. Happy investing!